Alright, gather round, because today we're tackling a question that's been whispered in the digital corridors of finance for years. Is Bitcoin a true hedge against the whims of central banks? Or, is it something far more intriguing, a kind of digital canary in the coal mine, exquisitely sensitive to every subtle shift in monetary policy? Prepare to have your assumptions challenged, because recent AI-driven research suggests the answer is far more nuanced than you might think. For years, the narrative around Bitcoin has often positioned it as a digital gold, a decentralized asset immune to the inflationary pressures or policy decisions of traditional financial institutions. The idea was simple: central banks print money, Bitcoin's supply is fixed, therefore Bitcoin protects you. But what if Bitcoin isn't just reacting to what central banks do, but to what they might do? What if it's listening to the whispers, not just the shouts? This is where cutting-edge AI steps in. Researchers have developed a high-frequency monetary policy expectations, or MPE, index. Think of it like this: a massive large language model, an LLM, is unleashed on over 100,000 market messages, news articles, and analyst reports. Its job? To classify every single piece of text as either hawkish, meaning the central bank is likely to tighten policy, or dovish, meaning they're leaning towards easing. This gives us a real-time pulse on market sentiment regarding future central bank actions. And the findings are rather stark. This AI-driven MPE index reveals that hawkish narratives, those whispers of potential tightening, consistently trigger a negative price response in Bitcoin. Crucially, this happens independently of actual interest rate adjustments. So, it's not just about the central bank raising rates, it's about the expectation that they might. Bitcoin, it seems, is less of a rebel and more of a highly attuned listener to the central bank's mood music. The research goes further, demonstrating a concept called Granger causality. In simple terms, this means the MPE index doesn't just correlate with Bitcoin's movements, it actually has predictive power. The AI's assessment of central bank sentiment at time t can help predict Bitcoin's returns at future time t plus k. This isn't just a coincidence, it's a statistically significant linear predictive causality, suggesting that these AI-derived expectations are a leading indicator for the digital asset landscape. But the story doesn't end with simple linear causality. The researchers employed advanced techniques like long short-term memory networks, or LSTMs, combined with Shapley additive explanations, SHAP, to uncover even deeper insights. What they found were pronounced non-linear, macroeconomic regime-dependent interactions. This means Bitcoin's sensitivity isn't static, it changes depending on the broader economic environment, making its relationship with central bank expectations incredibly complex and dynamic. So, let's re-evaluate our understanding. The traditional view often painted Bitcoin as a pure inflation hedge, completely decoupled from the fiat system. A digital safe haven. But this new evidence paints a different picture. Bitcoin appears to be a highly sensitive barometer of central bank signaling, with AI-derived sentiment acting as a potent leading indicator. It's not ignoring central banks, it's acutely aware of their every perceived intention. When we observe significant volatility in digital asset markets, or shifts in broader market sentiment, this research offers a powerful lens. It suggests that these movements aren't just random fluctuations, but rather a sophisticated response to the unspoken intentions and perceived direction of central bank policy. The AI-driven insights provide a leading indicator, allowing us to understand the underlying drivers of digital asset valuations with unprecedented clarity. Bitcoin, it turns out, is a master at reading between the lines.